Hi everyone. Welcome to yet another interesting and a very short session on the balance sheet as a broader topic, within which we are going to talk about very interesting, relevant, important aspect of the shareholders' equity. So, what's to talk about it? Huh? Shareholders' equity at the end of the day is asset minus liability. That's true. And whenever we have to value a company's equity, we can value the asset, value the liability, and the difference between the two is actually, as a matter of fact, the total value of equity. And why not? Because one of the meanings of equity is the claim on the firm's asset after meeting third party obligations. So there's nothing wrong in that. But sometimes, as shareholders, we need extra details beyond the total value. And that detail is in terms of the reason of this wealth getting accumulated. What's the reason that at the beginning of the year, the wealth was X rupees, and at the end of the year, it's Y? So A minus L is going to give you these numbers of X and Y, perhaps may not be able to give you the reasons as to why has the wealth gone up. So in this video, we're going to talk about certain reasons. I mean, to be precise, four for a general person and six for a B school student, that you will have to remember could be one of the reasons that uh, the wealth of the shareholders can go up. And every time, we have always got confused that what is the difference between a share capital and equity, or share capital and shareholders fund. All that differences are going to be ironed out. Okay. So I'm going to start off by requesting you to think equity to be a big bag with few pockets in it. And those pockets are pretty much independent of each other. There is some relationship between the two, but that's more logically connected from the point of view of memorizing them. But it is possible, very much possible, that all the six pockets that the equity as a bag has are completely playing independent to each other. So it's possible that the first pocket is impacted without any effect on the second to fifth, and vice versa. So think of it like a big bag. The total value of equity asset minus liability is the value of the overall bag. But we are now at a point where we want to find out as to which pocket is the reason for that increase or decrease in the value. Okay, people, like I said, for a lay person, they're going to be four. Allow me to start with that. The names that you see here are and for some people, for commerces, of course, they would have looked at it before. But even for them, there would be some names which are relatively new, like accumulated OCI. But I think the sense is to understand the meaning behind it rather than be lost in the syntax. And that has always been our approach towards the B2 classes, right? So I'm going to start off by really giving you a very simple thing. This is why am I clubbing one and two? What's the logic behind it? This is the money that comes out of the pocket of the shareholder, out of pocket of the shareholder. Okay, and I remember doing with a case with you wherein we said 162 is the total value given by the shareholder at the beginning of the year, which became higher by 194 to become 356. So we said, has the shareholder gone up? Of course, yes. And what is the credit that the company should take? At that point, we said that 162 cannot be taken as a credit by the CEO of the company because 162 was originally given by the shareholders. That 162 is 1 plus 2 put together. On the slide, you see the bifurcation here. And for that, I'm going to take example of Reliance Industries, the recent rights offering that they've done. So there's something people call as the face value of a financial instrument. It's typically the denomination written on the face of it. This is used for calculation of dividend, calculation of interest, should it be debt instrument, or an FD for that matter. So face value is not the market value. Market value is on the basis of demand and supply. Market value is on the basis of what the company can do tomorrow. That's market value. Book value is the overall equity put together, all six cubicles put together. So what's face value? Face value is the third value which comes first in the life of any financial instrument. That's the value written on the contract. has no meaning except to calculate certain dividend returns, to pay some stamp duty to the government. That's the level at which authorized capital is calculated, and so on and so forth. So the size of the capital from a regulatory point of view is calculated basis the fair value, which for Reliance Industries' recent most right share was only rupees 10. But you know how much money did they raise from the shareholders? The market value, the total value is 1257. So may I ask you, what is this 1247? It is the incremental value. This is the issue price. It is the price which is finally going to come out of the shareholders' pocket. 1257 is the sum total of both of these put together, out of which 10 rupee face value, on which stamp duty will be paid, on which dividend will be calculated, is only 10. And the premium, the name itself is delta. Huh? Premium is anyway meaning delta. That's 1247. If someone asks you, what is the meaning of security premium? It is the amount by which the issue price exceeds the face value. Okay? In India, the face value could be 2 or 10. Well, you don't have to really get into that. Whatever is the face value, that's the basic denomination. Anything over and above that is your securities premium. In some markets, we also call it additional paid in capital. Huh? Securities premium. That's an Indian name, securities. 3 and 4 are again clubbed together. This is the third and the fourth pocket, which has to do with incomes and expenses that the business is going to earn for the shareholders. So 3 and 4 don't come out of the pocket of the shareholders. In fact, that's the increment in the wealth because business is doing well. Typically, for a startup, this three is going to be a huge negative. Typically, for a successful company like Alphabet or Apple or Amazon is not a great example because Amazon is more a valuation game than a profitability game. But yeah, Apple is a classic example. Coca-Cola, McDonald's, these are all in Indian context, Maruti Suzuki, Reliance Industries. There's a huge profits that they are making, and when you make huge amount of profit, don't pay out entire amount as dividend. You have huge amount of retained earnings. This retained earnings is what is officially called as reserves and surplus. So of course, reserves and surplus are created out of earning attributable to equity shareholders. We did that in EPS. That level of profit belongs only to the equity capital provider, and therefore entire amount that we're talking about is for the equity capital provider. Okay, shareholders which are preferred, which are preference shares, have no right over these reserves and surplus. These reserves can be used to pay dividends in future. They can be used for a particular purpose which shareholders want it to be. It's like shareholders' money which they have earned through the business, which is lying with the business. Okay, the possession is with the business, but the ownership is of the shareholder. Okay, that's what reserves and surplus is. Profits earned, not distributed. And point four is again very simple. It's an alter ego of point three. Whatever you earned through OCI, remember special transactions didn't enter P&L, directly hit equity, are also one of the incomes and expenses which got accrued, but are temporary and out of control. Now, it's possible that in the first year you had 10 rupees of such income. In the second year, you again had 20 rupees. So the accumulated incomes like those which are parked under equity is 30. So remember, balance sheet is a photograph, cumulative as on date, be it a previous year's phenomena or the first year in the company's life. Everything will be captured on the balance sheet. It's no more delta playing, huh? It's cumulative, it's photographed till that day. So that's how out of 6 pockets, I give you 4. And with that, I give you 2 additional pockets. You see here, you may not find these in every company's balance sheet. Okay, now there is a logic behind it. Point number 5 is very similar to something called as buyback. Now you know what the buyback is. Return of capital. So basically the company is paying out cash. So cash goes down and share capital goes down because the membership ceases to exist thereafter. And in that process, the company's shareholder is the contract is over and the shareholder is no longer the member of the company. So the size of the company goes down as an impact of buyback. Treasury stock is exactly similar to buyback, except that the shares are not cancelled forever. They are just kept with the company as reserves, in substance almost similar as if the size of the company has gone down. Mm, Confusion, huh? Company is holding its own shares. On a separate day, I'll talk about treasury stock in detail, but here on, we can just look at it that Reliance is buying Reliance share. It's not Mukesh Ambani who is buying Reliance share. So you see the difference between it's not investor who is buying. It's Reliance Industries buying the Reliance Industries equity share, purely a financing transaction, which in a normal buyback case, they would have torn it, the size of the company would have reduced, cash goes down, share capital goes down. That's exactly what happens in treasury stock as well. Cash goes down and share capital goes down. You see, more the treasury stock, more the deduction. Again, similar to more the expenses, lower the profit. So it's a negative equity. It's a reduction in equity. More such shares, the shares out in the public have gone down. Okay, so look at it like a float adjusted market capitalization. Okay, anyway, so if that float adjusted doesn't make sense, it's fine. But just look at it, that treasury stock is like one step short of buyback. So treat it almost like buyback, right? And the fifth angle that we have here is again very contextual. You'll be lucky to find it because those balance sheet would be then consolidated balance sheet. And again, I'm not getting into it. All I can say is that a consolidated balance sheet is like a joint family presenting its consolidated picture to an outsider just to show the size of the group, how good, bad, ugly they look. And when you consolidate meaning company A merging the balance sheet of their subsidiaries, in that merging process, if the ownership is 60%, the rule is you merge entire 100. Don't have to get into the logics right now. You had to merge 60, but you have your stake, but you merged entire 100. That means 40%, which belongs to some other shareholder of your subsidiary, that also you have merged. Huh? That extra 40% is reflected as minority interest. Therefore, you would find minority interest only when there is a merging happening, consolidation happening. There is a standalone financial statement that you would also have to prepare. In that, the minority interest would never be shown. Okay, now these are the two extra things that you have. So, people, I just want to kind of quickly summarize. Equity is a bigger bag whose total value you can find out by looking at asset minus liability. But what is the reason for this total wealth? You have to look at it in six pockets. Each of these six pockets would be very different from each other. One and two could be clubbed together because both of them come out of the shareholders' pocket. Three and four is earned by the business for the shareholders, of course. Uh, and more the dividend, lower the three and four. So think about it. Like a private company typically don't pay dividend, startups don't pay dividend because they want to really grow their three and four. Okay. And five and six, the pockets like treasury stock and minority interest, you would be lucky to find it. Very exceptional, items to see in a particular balance sheet. Treasury stock, even more exceptional than minority interest. And you don't have to really get into too much detail with regards to five and six. Okay, so in my live class with you, I'm going to build onto these concepts and ask some analytical part, show you some practical aspects of the HUL balance sheet. How is FY20 different than FY19, and what happened during FY20? Forget about COVID for that moment. What happened during FY20 so that the wealth of the shareholders from an X level went on to become Y, even in spite of all that slowdown, etc., blah, blah. So all that reasoning, we'll have to divide it into six pockets, which we are going to do in our live class using that practical case, right? People, I look forward to meet you with all the excitement, all the knowledge. Now this is really becoming like a serious affair. Thank you for watching this with all the sincerity. Looking forward to meet in the live class very soon.